Good afternoon to our European clients and good morning to all our overseas clients, and welcome to Arctic Securities Macro and Oil Market webinar. My name is Anders Bergen and I will be moderating today's session. Today's webinar is scheduled to last approximately 1 hour, including Q&A sessions in between the presentations. Today's speakers are Arctic Securities Chief Economist, Mr. Stein Bruun, that will give us his views on the global macro outlook. Secondly, our senior oil market analyst, Ole Rikard Hammer, who will cover the oil market development and give us his oil price predictions. And finally, our senior E&P equity analyst, Daniel Stenslet, giving his topics in the E&P sector. We will start this session with Arctic's chief economist, Mr. Stein Bruun. He will give us his views on the recovery of the global economy. And Stein, I guess investors are scratching their head these days, wondering how the development in the US 10-year treasury rates will affect the global investors' positioning in the stock market. Do you think they will go for growth or cyclical stocks?
I think they will go for cyclical stocks and probably more in European markets than in the US markets. The uptrend in the 10-year yield has paused lately, but I think it will resume before long. And then we'll see the rotation trades coming back again. And I also expect that concerning the macroeconomic developments, I do expect some rotations over the coming 6 months. A first thing to note is that not only was the pandemic recession extremely deep, but the recovery has also been extremely rapid. And in fact, by the end of last year, the global GDP was back at the level before the pandemic started. That was thanks to China in particular. But if you look at on developed markets, we think that the GDP will be back at the starting point by the midst of the current year. And that's quite more rapidly than following the great financial crisis, when it took more than 3 years for developed markets GDP to be back at the starting point. So this rapid recovery has also already shown up in some strains in certain markets, and I think they will become more notable going forward. Concerning different demand components, what's really surprising towards 2020 was the continued strength in business investment. Of course, private consumption recovered sharply over the second half of the year, fueled by fiscal stimulus in the US, but also the turn in activity in Europe. But amid all the uncertainty concerning vaccine developments, I think that one important surprise, positive surprise, was the strength of business investments. And one of those rotations that I do expect is that going forward, we will see more of investment coming in the form of, say, non-tech related business equipment. While we last year saw, of course, due to the effects of the pandemic, we saw that IT investment, tech investments in particular, both hardware and software were surging, as you can see on the right-hand side of this chart from the US. Currently, orders for capital goods are extremely strong, as seen on the left-hand side, both in actual orders and also the purchasing managers indexes, which on a global scale sees the new orders component almost at a record high. So we will see continued strength in business investment, but a shift from tech investment towards more traditional equipment. One particular thing with this recession was that the effect on labor market has been made up for by huge transfer from the governments to households. In the US in particular, it's through all these cash checks. We had 3 rounds of cash checks. The first one was a year ago. Then we had this package vetoed in December of transforming $600 per individual to US households. And the further step up in this package from the Biden administration vetoed in early March. In addition, we also had transfers in the form of extended federal unemployment benefits. In Europe, however, the governments have been using short working hour schemes to subsidize wages to keep people on payrolls. So the effect on employment in Europe has been much less than in the US, but more of the adjustments have come through a deeper cut in hours worked. The effect of all these transfers, and also the effect of the lockdowns last year, the effect on consumption, has been that households' saving rates have increased quite tremendously, and there's a lot of excess savings in the household sector, which certainly at some point will be used to fuel consumption going forward. But one of those shifts I'm talking about is that most of the pent-up demand, at least for the US economy, is in service consumption of services, while consumption of goods in the US is already far above the pre-pandemic level, and also the growth rate in such consumption has been also much stronger than we saw prior to 2020. So in the US, most of the pent-up demand is for services, while in Europe, as you can see on the right-hand charts here, there's a broad pent-up demand both for goods and for services. European, or rather Eurozone retail sales is still below the pre-pandemic level, and it's come down quite a bit from levels last autumn. And also auto sales are some 30% below the levels prior to the pandemic. So it's a more pent-up demand in in the Eurozone, and it's more broad-based than in the US. So here we'll see another shift going forward. Concerning manufacturing, we might possibly be in peaking territory when it comes to some manufacturing indicators, especially these PMIs, the Purchasing Managers' Indexes, which are at record high levels in the US, at record high levels in the Eurozone, and very inflated in the UK as well. And while it's not shown here, the ISM manufacturing index is actually the highest since late 1983. So those indicators might be in peaking territory, but that will not mean, if you have a reversal, will not mean that the cycle will turn for actual manufacturing production. Quite the contrary, I think that production will stay very strong going forward. Obviously, the maximum rate of acceleration is behind us, but there's a lot of pent-up demand. There's a very strong order inflow already. We do have some hiccups in the global supply chain, which means that there's a hefty backlog to work through. And also inventories are currently low. So manufacturing production will stay strong for quite a while after these PMI indexes have peaked. But for markets, it might be a shift when they say that the ISM index in the US is coming down, is moderating somewhat. So there might be a sentiment shift due to that, but the actual developments will prove much better. At the same time as these bottlenecks are worked through, and those bottlenecks has in particular hampered manufacturers in the developed world, in Europe and in the US. I do also expect a shift in export flows, in trade flows, which up until the turn of the year was dominated by extremely strong exports from Asia, not only from China, but also from, say, Taiwan and Korea as well. And that also reflecting high demand for, say, and you all know the bottlenecks in semiconductor production. But also the more general trend in business investment towards tech investments last year. So when we have a shift in the investment flow in the developed world, we probably also see a shift in the export flow, with export accelerating from from the US and Europe, and while not slumping from Asia, there will be a shift from the extremely strong growth rates we are currently seeing. A third shift will probably be between the goods producing sector and the service producing sector. The service sector certainly have a lot of catch up to do. And because in Europe, at least, we still have quite severe restrictions currently. And one illustrating example here is what's going on in the UK when they started to ease those restrictions back in March, and in April also allowed non-essential shops to reopen, etc. And you had this dramatic surge in the PMI for the service sector, actually up by some 10 points in 2 months to a very strong 60 reading in April. And I think that the rest of the Eurozone will follow in due time when we have this mass inoculation, which will allow for a reopening. Exactly pinpointing when the reopening will start in the Eurozone is a bit hard, but I guess that the EU is on course for vaccinating 70% of with the first shot of the adult population by end July. But certainly the reopening will start sooner, maybe very late in May or during June. And at that time, I think we will see that a number of indicators in the Eurozone will turn sharply stronger, as we saw last spring. Due to this rapid recovery and due to the composition of demand, we have seen that bottlenecks has been forming already. Again, using these PMI surveys as an indicator, the supply delivery time is almost at record highs, and certainly has an effect in increasing input costs for manufacturers. And they are also seen that they started to raise output prices. And on the upper right-hand side, you can see the relationship between the PMI output price indicator and the manufacturing producer prices in the OECD area. And certainly it looks like we are in for a surge in goods prices, at least from at the producer level, not so much at the consumer level, but at least on the producer level. And it's notable that if you listen to all these conference calls currently underway in the US in connection with the Q1 earnings season, it's notable that inflation is quite high up on the agenda for CEOs and CFOs. So certainly there's something is going on under the surface, is bubbling inflation pressure. I do not expect that inflation will say on the consumer price level will be up in the 4 or 5%, but I do expect that inflation might prove more sticky in the US than currently expected, because we have seen that US consumer prices made a jump in March. Headline consumer CPI up from 1.7 to 2.6% year on year, and the core measure, excluding food and energy, up from 1.3 to 1%. This was mainly due to base effect, as prices kept on falling last spring due to the pandemic. And certainly there is, I guess, it's a consensus and also the expectation in the US central bank that this hiccup in inflation will prove temporary. And in due time, when these base effects have been worked through, we'll see inflation moderating again. The peak will probably be in May. Will headline inflation up at 3.5% and core inflation at 2.5%. But if it's only down to base effects, we will see that the year-on-year rates will subside, come down quite a bit from the second half on. I do expect that these trends will not revert themselves. I do suspect that we will see a more lasting higher inflation rate, not a very high rate, but anyhow, if inflation should stay at 2.5%, it will have some effects on certainly on bond yields. And one point here is that while most of the acceleration in goods prices might be over, We'll see a normalization in service prices as the economy starts reopening more and more. And in particular, I think it's overlooked a factor that rent inflation is about to turn higher. Rent inflation has actually been working the other way around this spring because the year-on-year rate has fallen from 3.4% to 2%, and rents are making up 40% of US core CPI. So it will be extremely important going forward. And as you can see from the chart on the bottom right-hand side, there is a relationship between US house prices and rents with a certain lag. And housing prices in the US are currently rising at more than 11% annual rate, and suggest that rents will turn up higher as well from the second half on. So that is one important item which could keep inflation higher than currently expected. Another sign of let's say speed limits already is that the labor market, while we still in the US 8.4 million short of the level of non-farm payrolls prior to the pandemic, and even though the employment to population ratio is still 3.3 percentage point lower than slightly more than a year ago, companies are already stating that they are problems to fill positions for the moment, which is a sign that there's a lack of available workers or mismatch in the labor market already, which is rather surprising. So we could see wages firming somewhat going forward, although I do not think that wages will be that important in fuel inflation. Anyhow, overall, our outlook is for global growth to be extremely strong, as everybody expecting this year, slightly more than 6%. And we also see that we also expect growth to remain way above trend next year at 4.5%. We do see all these rotations going on between the various demand components, and also that we will see a shift in the growth leadership. US has already taken the baton over from China at the start of the year. We will have US GDP numbers on Thursday, which will be extremely strong, while we saw a surprisingly sharp downshift in China. The UK will see tremendous growth in the current quarter, while from the third quarter on, I guess that the growth in the Eurozone will be even stronger than in the US. So if you turn to bond yields, most of the turning bond yields in the US 10-year yield reached an all-time low of 0.52 last August. It peaked at 1.74, and most of that increase was due to a normalization of inflation expectations. But inflation expectations at some 2.4% do not include any risk of an even modest but more lasting overshooting of inflation that is currently priced into the market. And certainly that will also be important for the Fed. And second argument concerning long-term interest rates is that at some point, I guess from early 2022 on, the Fed will start winding down their hefty asset purchases. They're currently buying a US Treasury and mortgage-backed securities for $120 billion a month. And when the market sniffs that the Fed is about to discuss how to start this tapering of the purchases, I do expect that we will see real rates going up, because they are still extremely low. And the last time we had this situation back in 2013, actually all the upturn in long-term government bond yields in the US was due to higher real rates. While this time real rates have stayed low, and it's more about inflation expectations. So higher real rates will also push up the nominal rates in the US going forward. The implications for equities will. I'm still positive on equities or equity markets as such, but I think we will see a rotation of between sectors. We actually started last autumn with all this vaccination breakthrough. We saw that people started shifting into more cyclical stocks out of growth stocks and into what is called termed value, which is mostly cyclical stocks, and I think that will continue. In due time, we had the trade has paused as long-term or as the 10-year bond yield in the US has come down over the past four weeks, but I think that this trade will reassert itself in due time. And obviously, there's a hefty shift in earnings going on, and this earnings season for the first quarter, we'll see expected to see earnings surging on the year-on-year basis. And while valuation is rich in market, I think that we will a continued uptrend in equities will be substantiated by earnings expectations being revised higher over the second half, and probably it will be more in Europe than in the US, using some cyclical metrics on earnings, as you can see on the right hand side. There's probably more potential for upgrades in Europe, in Euroland, than in the US. So I tend to favor Euroland stocks because they are more cyclical. And if you look on the right hand side on this slide, you will see that the expectations for earnings next year, 2022, which could be sort of a normal year and back to 2019. EPS consensus EPS for Europe Stock 600 is some 12% higher than next year than in 2019, while it's twice that rate in the US. So I think it's more potential in Europe than in the US. So if you think that US yields will start rising again, you should overweight value cyclicals and in particular European equities. Thank you.
Thank you, Stein. I have one question for you. I guess there's a lot of investors out there starting getting fear of heights. If you were to point at one potential black swan event that could happen, what would you say? Is it the China-US trade war? Is it the fourth wave of COVID-19? Or what could derail your outlook?
I think it's a combination of certain things. I think that make markets are currently too complacent about inflation not being high, but staying at these levels for a longer period of time. That will have certain implications for the Fed outlook. And I also think that market will might come to grips with, well, so far in the US, we have fiscal stimulus financed by debt. But future fiscal stimulus will be financed by higher taxes. And I sense that market really hasn't put high corporate taxes into their forecasts. As you can see on page 21, upper right hand side, we haven't seen any adjustment in earnings expectations for the US following the proposal to lift corporate taxes to finance this new infrastructure investment plan. So that might come more into focus. Might also have a negative effect on markets. Concerning black swans, well, you don't see them often. I met one once at hole number 13 on a Spanish golf course, and while I was playing into the green, certainly my ball ended up in the water.
Thank you very much, and thank you for your presentation, Stein. I think we will be moving on to the next presenter. Our next presenter is our senior oil analyst, Ole-Rikard Hammer, that will give us his latest development in the oil market and give us his view on the road ahead for the oil market and what to expect when the global economy starts to re-accelerate. Ole-Rikard, I always start out with a question to you. With expectation of a re-acceleration of the global economy and subsequently an expectation of a higher oil demand, I guess the pessimists out there will say then the shale players will start to press on their production accelerator. Do you see an increased shale production a risk to oil price outlook?
Thank you, Anders. No is the short and crude answer, with a quick follow-up in the short term to qualify. The follow-up question, I guess, would be after a great first quarter, is there now more good news in store for oil? And the answer to that question is yes, we think it is. If you go back a few months, second half of last year, and the conventional oil market analysis from the IEA would point to potential return of oversupply and the troublesome first half of this year, certainly if COVID was to reassert itself. Our theme today, Bridge Over Troubled Water, will deal with why this is not happening, and we got some good help in bridging that gap into a stronger second half. Just to qualify our position in the oil analyst universe, for those who haven't listened to us, we are bullish on oil, I would say, from a cyclical standpoint, towards the middle of this decade, on the core thesis that we think the challenges on the supply side of the market will prove to be more acute and bigger in terms of generating any kind of growth than the challenges to the demand side from the energy or from the green transition perspective. So we see a tightening market going forward. That's sort of the big picture view. Today's presentation is going to deal more with where we are in the short term and how things are looking. We recently upgraded our oil price forecast. That's the third time this year. We were at $60 or $55 starting the year, quickly went to 60. Our latest forecast now is at 68, which for those of you who do the math, factoring in what prices have done year to date, means that Brent is due to average $70 for the rest of the year. The drivers for this change, we've seen demand being very strong and set to strengthen further as the economy accelerates, as Stein pointed out, and we get the positive tailwinds from the vaccines, hopefully. Also some seasonal factors on the corona this year as last year. The inventory surplus is basically gone, and we think we will move into clear inventory deficit, a supply deficit in the second quarter. But the real reason, main reason for our upgrade is that OPEC Plus is proving to be more aggressive or hawkish, to put it that way, on prices, as they are targeting higher prices over volume increases, which is lasting for longer than we initially had expected. So that that's the main factor why we have upgraded the forecast. We also look at non-OPEC, which essentially is static in the near term. Shale is flat at best in the near term. Things may change. We'll get into that. We don't see a return of Iranian oil until the second half of the year, but then we definitely do see a return of it. Then we have left our forecast for 2022 unchanged. Meeting with our clients over the past week, I'm getting more pushback on why not upgrading for next year than why I upgraded for this year. So that indicates that there is, some element of bullishness out there for sure. I think the reason we have decided to stay at 65, which we've held for some time, is that I do think we will see a supply response sometime in the second half of this year into 2022, and the history of the oil market will show you that when supply starts to increase, we tend to get some price reactions. But if I was forced to make a change on our next year's forecast this year, then that would be an increase, not a decrease. So that's sort of where we stand on the price front right now. Let's move into our assumptions a bit. Here we have developments on oil demand. Starting in the upper left-hand corner, we got global demand with the dotted line being the projection. These are the IEA numbers. Ours are pretty close, and the full line being the actual data. We've said for some time that watching for and looking at the actual incoming data was more important than paying attention to the forecast. The reason was that when you had such extreme changes in oil demand as we've seen over the past year, what the IEA or anybody else is actually forecasting, I think, is of less value because it's a chaotic world. It's much more has much greater value to look at the actual data, because that is telling us whether in the issues we've faced have been sort of light off or light on or light off kind of problems, or if we're starting to see changes in the underlying dynamics of oil demand, i.e. these structural changes relating to the green transition, that transportation patterns or modes change, people are not traveling, etc., etc. So far, we've seen very little of that. And I would say, based on how quickly we recovered, about 2/3 of the drop, our clear conclusion is that as the economy has been allowed to reopen, oil demand has returned quite quickly. That's why we're also positive that we will see a stronger growth in the second half of the year as the economy is supposed to reopen, and the setback over the winter has been fairly moderate, i.e. just a minor pause really in the rising trend. The other takeaway point here is the breadth of the demand improvement. We see in the upper right-hand corner China, which was first in and first out of the corona crisis. They've been in positive growth modus since Q2 of last year. They are, of course, in Q1 this year, significantly higher than a year ago. We see that the absolute numbers have moderated. I think that is mainly, self-induced by China, who took some precautionary measures in Q1 to avoid the flaring up of the COVID. We think very much that the demand figures are now poised to strengthen, and again, we're seeing very strong macroeconomic developments in China that's going to push oil demand higher. We see in the lower left-hand corner, we got US oil demand, which is now stabilized at roughly 19 million, a little bit above 19 million barrels per day since late last year. It's instructive to note that US oil demand to date, i.e. for the first quarter and a bit, is already up year to date versus last year, and that's before we get the full effect of the collapse in last year's figures, which of course will push the growth rate much higher. So we are already at the level that the IEA thinks will be the average for the whole year, and that means if the economy really starts to fire, and all the indications are that transportation demand is now picking up in the US, there's very little room left until you have to raise the full year forecast. So that's positive. Europe has been the laggard. That's where you can maybe talk about the W rather than a V in terms of the demand developments. January was a new setback with a drop-off due to the second wave of the corona, but the initial figures for February show quite a quick rebound. And I think it's again instructive when you look at Europe and also other economies, that compared to a year ago, even if we have resurgences in the corona, we're seeing still strong economic data, notably from the manufacturing sector, while a year ago we just saw everything fall off a cliff. So that's telling us that the economy has to some degree learned to live with the corona. Final note on the bearish side would be the developments in India. Certainly now they are at the core of the latest COVID resurgence, with some disastrous records set every day in terms of new cases. Indian oil demand will take a hit on this, but it has to be kept in perspective. India is about 5% of global demand, would contribute maybe 10% of the recovery this year. I think in our view, given the improvements we see elsewhere, provided that the problems in India stay in India, we think the global market is capable of dealing with it. So the message is that the economy is recovering, so is oil demand, and there's few signs of any structural changes as of yet. And we've learned sort of to live with the COVID. Given the expected increase in demand this year, I think it's obviously it's a lot of focus is on the downside risks to demand. We think it's prudent to look at the upside risks as well. This graph, these two graphs show development in oil demand forecasts, with the lower graph being the forecast that came out related to the financial crisis. So it started in July 2009 with the forecast for 10 at 1.5 million barrels per day, wound up at 3 million barrels per day. So Clearly, analysts were too low, and our observation is that analysts tend to be wrong, everybody, including ourselves, in terms of getting the magnitude right at big turning points. Definitely did not get the magnitude right last year, but now we're turning to the upside. We may not get it right to the upside this year, and we see a positive trend in the demand forecasts for the last few months. So we think there are some upside risks here as the economy begins to accelerate. Looking into next year, I think there's two key observations. Number one is that demand growth is likely to be quite high next year as well. This year, a record 6 million barrels per day. But of course, that is recovery from the corona. But next year, I think it's quite easy to get to a number of maybe around 3 million barrels per day if you assume that some of the hardest hit industries in terms of services and transportation are allowed to continue to recover. That's not the difficult exercise to get to 3 million barrels per day, which is a number well above trend. Word of caution would, of course, be, again, to look back at the financial crisis, where we saw the 2011 demand development was a bit of a disappointment and had little follow and no follow through actually on what happened in 2010. So that's a word of caution. Stein mentioned that some macro drivers might go in reverse. I would throw in that the lagged effect of rising oil prices may have some impact, but at the outset, I think we could expect certainly a demand number starting with a 2-something, which is a high number historically. So I think the demand side from a cyclical perspective, definitely very strong with no real cyclical or structural changes visible as of yet. Switching to the supply side, that's really where the game is becoming very interesting in our view. Here we got the monthly oil production data, and we've done a little exercise in comparing global production in the current corona crisis with how it developed during and after the shale crisis and the financial crisis respectively. And we've set ground zero from the outbreak of the crisis, and clearly you could see how dramatic the supply developments have been during the corona crisis with OPEC plus cutbacks plus the reductions in shale, bringing down output about 10 million barrels per day in Q2 last year. But the key here is that the rebound has been quite muted, and the muted rebound really reflects that we're starting to see the drag from a long period of low capex budgets. If we go one step further, look at the breakdown here of non-OPEC production, and we're talking here about non-OPEC plus, which means we've taken Russia out of the equation since they're playing more ball with Saudi Arabia than others at the moment. I think the key takeaway here is the very muted rebound expected this year and next from the drop that we saw last year. Where if you compare that to the rebound we saw after the shale crisis, that was very quick and very aggressive. And again, I say that the key points here is to think about the supply side as being under pressure from the capex cuts that took place in 2016, 17, which really didn't start to impact the market until around last year. So the industry was already barely back on its feet when it was hit with another wave of capex cuts, and that's putting it under pressure. And there's interesting to note that there are relatively few single countries who really can give us any surprise here. Neither Brazil, Canada, nor Norway are capable of coming up with big changes in supply, almost irrespective of what prices will do. The only country that really can surprise us is the US. And I said quite crude answer on this question to start with, if US shale production growth was a risk to the forecast. And no, it's not in the short term. It could become an issue next year. But again, we have had a very strong belief that the problems for US shale, the industry really entered into a downturn in 2019, not 2020. And we see here on the left-hand graph the development in the drivers of production. They've fallen very sharply, and although there's certainly is a recovery in the last few months, I think the proper perspective is to compare how this is looking year on year, whether you look at number of rigs employed, number of wells drilled, number of wells completed, you're still down 50 to 60%. Even more importantly, you're down from levels when the market bottomed after the shale crisis in 2016, as we highlight on the left-hand side. That's very important because current production is about 1/3 higher than in 2016. So if you're using and drilling 50%, or not 50%, but if you're drilling less wells now than you were a few years ago, and production is 30% higher, and depletion is an issue, I think it's to us. We think it's unrealistic that you have a productivity improvement which can offset those headwinds. What's currently going on is that the industry is drawing down inventory, as you can see from the gray graph in the background. That's the number of drilled but uncompleted wells, the so-called DUCs. They're down around 20%. To us, the real signal here is the lack of drilling, which means that inventory depletion, is going to run its course, and the lack of drilling has to do with the lack of capital and the change in the industry's business model and the consolidation of the industry, which means it's going to take time before we see the same strong rebound. Looking on the right-hand side, we see developments in actual production. The dotted line is the EIA forecast. I think it's, again, important to note that the trend in shale production definitely is down, although the latest actual number for February was, of course, affected by the freeze down in Texas. But before then, it's been a steady drop since last fall. And simply put, the industry is not employing enough rigs nor drilling enough wells or completing enough wells to offset depletion. That's why production is still falling, and we think the IEA and EIA, who have scaled back their forecasts, still are a bit optimistic. But there's no denying that we are heading for a cyclical recovery in U.S. shale production, but we think it's going to be very muted relative to the past, looking at probably increases of maybe 5%-ish. From 2022 onwards, and not the 15 to 20% that we have been used to before, and that's going to impact on global output. Quickly here, in terms of market balances, we got here the dark blue line, which is OPEC, our estimate of what OPEC needs to produce in order to keep inventory steady. The light blue line is what they're actually producing. So there's clearly a supply deficit in the market at this point. OPEC has agreed to start increased production from next month, but in our view, the increase in production, a total of 2 million over about 3 months, is barely going to keep up with the expected increase in demand. That means the supply deficit is going to stay there, and what that means is that we're going to start to see inventories drop quite a lot further. We are already looking at the dark blue line here. We have already erased the inventory surplus built up during the corona. And based on our assumptions, and looking at the dotted part of the line, we are heading for the lower end of the range, and maybe into a new low in terms of commercial inventories over the next 6 months. What's that going to mean for prices? Well, if we look on the right-hand side, we got the cross plot between prices comparing to the relative inventory position versus the 5-year average. So at any given point, you look at what our current inventories versus the 5-year average, and you plot that against prices, and you could see that if we are heading into an inventory deficit versus the 5-year average, which we think we are, then prices typically are congregating in near triple digits. We're not saying we're going there in the very short term. There's more factors impacting on oil prices, but clearly this is a very important physical anchor for the market, and we think it's going to tighten and push prices higher in the short term until there is some change and response on the supply side. And let's look at what could happen on the supply side. It takes us over to how OPEC and speculation, you may call it, about how OPEC is thinking about the current situation. I think it's very instructive to look at the let's call it the playbook or the script from 2018. Prices are following that remarkably closely, and there's also a lot of similar factors in the market. Economy, overcompliance with cuts, etc. In 2018, we saw prices move to the mid-80s, but then a dramatic change with the fourth quarter of 2018, seeing prices move from the low 80s to the high 50s in just 3 months. We think Saudi Arabia in particular is very well aware of that situation, and they're working hard to avoid it. And in our view, I think they've concluded that the risk of a return of Iran oil is greater than the risk of a return of shale oil. And if there's little return of risk of shale, they can allow prices to go higher, and they want inventories lower in order to be able to absorb Iranian production. Speaking about Iran, as I said, to begin with, we definitely expect Iran oil back on the market. But we also feel relatively confident that it's not going to be an issue until the second half of this year. We know they were having talks in Vienna between the Iran and the US, indirect talks. I'm sure they're going to be direct talks and not too far away. But we note that there's a clear lack of trust between the parties, each wanting to have the other to move first before it responds. And our main argument is that it's quite easy to see that there are counter forces in both camps who really do not want the deal between Iran and the US. And we think that means this is going to take time. And we have Iranian elections coming up in June. So our view is that Iranian oil is unlikely to increase from current levels until the second half of the year. That's when they will probably start to come onto the market, but the full effect will probably not be felt until next year. And the point is that it will return when the market needs it and is able to absorb it. So that takes us into some conclusive remarks. I said at the beginning that we are positive, let's say, from a cyclical point of view for oil towards the middle of this decade. And you can see why on this picture. We got the bars showing expected changes in oil demand and non-OPEC supply, with demand growth very high this year as Corona rebounds. But I think the key message is that we see growth still remaining and gradually gravitating towards, let's say, a core growth rate of maybe around 1 million barrels per day, while non-OPEC production, the rebound will be muted, and then very quickly we are heading for virtually zero growth from non-OPEC. And again, that reflects what I said to begin with, that the industry is carrying the legacy of the capex cuts from 2015, and then they have additional cuts and repositioning from majors relative to the green transition, etc., which is going to make supply growth even more challenging. So the bottom line here is that all this means that the call on OPEC oil will rise, and you could translate the rising call on OPEC with rising pricing power to OPEC, and that's why we think oil prices are going to move higher, but not in a straight line, at least not yet, and a likely supply reaction sometime starting in this between the summer of this year and the summer of next year is likely going to produce some volatility and fluctuations in the price. But we definitely think that the floor in the oil market has become more solid, and the risk of a dramatic sell-off like we saw in Q4 18 has become lower. So on that, I would say relative constructive note, I will close my comments and say that those are the main reasons why we upgraded the forecast and our view on how oil looks at this point.
Thank you, Ulrika. A couple of questions to you. Firstly, the green shift doesn't seem to have any impact on the demand side, nor most likely more on the supply side. Where does that take us the next couple of years? At what point do you see the green shift actually have a real impact? And secondly, you're mentioning the call on OPEC will increase over the next couple of years, and there will be some kind of supply response. A little bit on the side here. That typically has some positive impact on the tankers. What's your view on?
Yeah, let's start with the main question, most important question, I think, from a big perspective, which is on the green shift. I think there's two really key observations here, which I think people tend to underestimate. And one is the very positive backdrop we have to global energy demand going forward. And yes, when I say positive backdrop, I mean the chances to see high growth are strong. We are seeing a world that's growing steadily and becoming richer, and at the 3% growth rate, the global economy is going to be about 50% higher as we get into the 2030s towards 2040, and that's going to push up energy demand. And we know the emerging economies are really hitting the threshold in terms of going in terms of middle class expansion. So I think the top line in the market is growing, and that makes the challenges to shift the energy mix even bigger. Instructive here to look at coal, which has had a direct competition from natural gas and has only lost a few percentage points in market share over the past decade. So I think it's going to take time, definitely, because you're not just talking about changing in the energy mix, you're talking about changing the energy system as you go from fossil fuels towards electricity. So it's going to take time. I don't see an impact meaningful impact before 2025. In terms, and I think the supply challenges are bigger in that period. In terms of the supply response, tankers, those of you who know me know that I've had quite a positive view on expecting a rebound in the tanker market. That has not happened. So the question is if there's some bigger negative forces that are working. I do not think so. Again, it's like forecasting the weather. You're seeing all the signs of winter aggregating, but there's no snow. So do you call off the winter, or do you wait a little longer? And I think the answer is that we wait a little longer. And I think the tankers are going to come back with a vengeance and follow other shipping segments higher.
Thank you very much, Ole Rikard. And we'll move on to the next part of the program, which is our E&P analyst, Daniel Stenslet, that will give us his E&P company recommendations. And I guess, Daniel, with all the positive backdrop from both Ole Rikard and Stein, it's fair to assume that you can probably buy all the E&P stocks out there these days, or what?
Thank you, Anders, for that introduction and that intro question. We'll get back to it. What I'm showing you on this slide is really our coverage universe. It's 15 E&P companies. I'm showing several metrics here. One of them is the price to NAV metric. I also divided the space into two categories, one being the large caps, the second category being kind of all the other ones, comparing them one to one. If we start with the large caps, what you see here, for instance, the base case column, that's the price to NAV based on our assessment of course, the NAV, and the NAV is based on a price deck with $68 Brent this year, 65 next year, and 60 in the long term. You can see that, for instance, Aker BP and Lundin, they are trading not that far from their full NAV. In Lundin, we see a Brent price slightly in excess of 60 Brent discounted in the share. In Aker BP slightly below 60. But I would say that those two names are priced not that far from their fair value, and not where I would seek exposure for further repricing. We see somewhat more upside in Equinor. I can go a little bit deeper into how we try to value that company. It's of course a huge animal, a lot of things to take into consideration. What we've done is to look at Equinor's normalized. When I say normalized, I mean I'm trying to strip out the effects of the temporary Norwegian tax effects. And based on our average Brent forecast for this year and next year, so in the average it's 66.5. That takes Equinor's total annual earnings to slightly in excess of $5 billion USD. If you apply price to earnings ratio of 13 to that, you get to around about 180 NOK per share for all the traditional Equinor, and then you get the contribution from renewables on top of that. And to put it a slightly different way, if you take out the contribution from renewables at the 30 NOK per share, traditional Equinor is trading at about price to earnings of 10 compared to its average within the time period 2016 to 19 of 13. So that should give some or leave some room for further repricing in Equinor. And you see how the company's been trading in the past. I've taken out kind of the effects of 2020 with the spike in expected forward price to earnings based on the downward revisions on the estimates. So then again, I think 13 is a quite fair set of data points to take the average for that time period. So you can say Equinor is standing out as our slight favorite among the large caps. If you look at the second group of companies, it's of course a very diverse set of companies with different characteristics. What I've done here is to highlight 5 of them, which I think have perhaps the best risk-reward prospects in a $50 to $70 Brent range over the next 12 months. What they have in common is, for instance, that they both or all of them trade at least 40% discount to their full NAV, and they will generate very strong cash flow either in a very short amount of time or within a couple of years, depending on their investment profile, but generate very strong cash flow not in the too distant future, and also having a very comfortable buffer down to their operating cash flow break-even levels based on where we are today. So I think with you don't necessarily need a very much higher oil price to see or justify significant repricing in these names, which would be the case in most large caps. And if we try to take a bit more company for company, I think Panoro and BW Energy, we've highlighted those companies at several occasions before. Even though they've been trading up significantly, they're still trading at a significant discounts. With the Rouge Hibiscus area coming on stream and contributing at the Dussafu field in about 2 years' time, they will generate very, very strong free cash flow yields. And if the ongoing appraisal well at the Dussafu license will confirm perhaps the main hypothesis from the company's geologists, the Hibiscus field could be almost 3 times as big as what the current 2P reserves indicate. And the actual 2P reserves in those 2 companies could be almost twice as high as what's booked today. So that's a very strong near-term trigger. We could hear news from that appraisal well within a month's time. And IPC, Gulf Keystone, those are a bit more established players in the sense that they're further out in their production cycle. They will generate about or they will generate their entire enterprise value in free cash flow within the next 4 to 5 years if Brent stays at the $60 trajectory. So that is obviously a very attractive payback time in those 2 companies. And also highlighted Petronor, which is also trading at a significant discount. At the same time, they're having a very active M&A strategy, and has proven in the past that they can leverage M&A to create values. I think that's another company to have on the radar. So that was my main points really. We think overall that the small caps, some selected small caps, offer a lot better risk reward based on a Brent interval, let's say in a 50 to 70 range over the next couple of years. And as they start to report quarterly financials going forward, based on gradually increasing production and in this mentioned Brent range, I think they will definitely justify a higher valuation. that was my main points, Anders, and I think we can open up for questions.
Thank you, Daniel. A couple of questions to you as well. If you look at Equinor, they have a significant portfolio of offshore wind, and where do you see what's the strategy of that company to divest or separate list parts of that segments? And secondly, the big caps are to an extent the value of the price NAV, however the small caps are significantly trading with a significant discount to the NAV. Do you expect there will be some kind of M&A activity from the big caps towards the small caps if this pricing environment stays the same?
You could say that, for instance, Noreco, which is to some extent a neighbor of Aker BP just a little bit to the south, could have been one such acquisition target. So that could be to be one kind of way to see it. I mean, for the other ones, I think the focus of these companies is just so different, and large caps are primarily focused on the North Sea region. So I struggle to see that really happening. But some of the larger independents and some of the larger companies in this second category could definitely acquire some of the smaller ones. Or I think what we actually could end up seeing is that some of the companies on this second list will leverage the ongoing divestment programs from majors selling non-core assets, for instance, in Africa. So I think M&A is definitely going to play a role in the space, but I, for instance, don't foresee Lundin acquiring DNO any point in the future. So yeah, that's how I see it.
And on the Equinor and the divestment of let's say green assets, where do you see that how that play out?
I think if you look at the wind and solar assets isolated, it would definitely make sense for Equinor to spin out those in a separate company. At the same time, there are some synergies, especially with some of the other low carbon initiatives that Equinor are working on. I'm talking about blue hydrogen, talking about carbon capture storage. So that those types of initiatives could perhaps have at least or function well within the current Equinor setup and ecosystem. So I think you can argue both ways. I think there's perhaps more likely that we will see some sort of spin-off within the next couple of years than not. But at least I think there will be some very strong ties between the companies if they decide to spin out. It's definitely, if they're doing it, it's to really visualize the values of the wind and solar business. But I think the way also most analysts are looking at the company now, they add some contribution from the renewable segment, and at least what I'm seeing from consensus is not differing too much from what I estimate. And if the company successfully kind of visualizes that kind of values, it's not necessarily it may not be that much incremental upside to gain with such spin-off.
And the final question, I see you have a buy on almost the entire on the entire list here of companies covered. If you had to buy one, which one would you buy?
Yeah, I think perhaps Panoro actually. It's a company that just made a very impressive creative acquisition. It's trading at roughly or not that far from 50% discount based on our base case trajectory. And I think they can, and that's also the case with BW Energy. We've seen such impressive development with how they've been able to develop the Dussafu license. And I think there's likely to be more discoveries to be made and more values to be visualized from that field. So I think it's very hard to beat the risk reward that I see, for instance, in Panoro. I think that would be perhaps the one I would buy. Thank
you very much, Daniel. Then I would like to thank Stein and Ole Rikard and Daniel for the contribution. To sum it all up, we have a significant tailwind both on the macro side that supports the macroeconomic environment, that supports the oil price outlook from Ole Rikard, and eventually that factors into the E&P stocks that Daniel just covered, and it seems like we can buy them all, but he will put his money on the Panoro. Thank you very much, and we look forward to see you next time.